Morning, and many thanks for joining this morning's briefing on the provision of national accounts and international accounts results for quarter 2 2022. We have some attendees in the room with us here this morning, so just for in the event of a fire drill, I'd ask the attendees to follow us down the back stairs here at CSO and to follow the instructions from the CSO staff. Okay. And as always, we will take questions at the end of today's presentations on the results. And can I ask people to use the chat function for questions, or to indicate if they would like to come off mute to ask a question through the chat function also. So today's results are showing growth in the M&E dominated sectors, primarily the industry and information and communication sectors. Also looking at the sectors more focused on the domestic market, we're seeing growth in some of these sectors, including construction, distribution, transport, hotels and restaurants, two of the bigger sectors focused on the domestic economy. We're also seeing tangible investment driving increased modified domestic demand this quarter. And this morning's briefing will take us through the detail and the breakdowns that will help us to understand the M&E activity and to understand what's happening in the underlying domestic economy. Again, as always, the slides from today's briefing will be available along with our statistical publications on the CSO website, and hopefully a recording of today's presentations will be available on the CSO YouTube channel. Contact details are available on the statistical publications and on the press release, so please contact us at any stage today or subsequently with questions on the results. So I'll pass to colleagues Chris and John now, who will take us through the quarter 2 results. Many thanks, Chris.
Thanks, Jennifer. So I have the quarterly national accounts for Q2 22 for you this morning. Many of the results for Q2 are showing us our economic indicators in a 1 to 2% range. GDP is up 1.8%, value of goods and services produced in the economy. We take out M&E profits, GNP is up 2.1%. The sector is not affected by M&E activity, or up just under 1% at 0.9%. And the value of goods and services that are consumed by households, personal consumption, is up 1.8% as well. Modified domestic demand is a little stronger, growing at 4.3%, and that's mainly, as Jennifer mentioned, because of the tangible investment of M&Es in the Irish economy. If we look at our infographic, we can see the GDP results there on the left-hand side of 1.8%. GNP at 2.1 above that, and the modified measure, MTD, at 4.3. The output income method is on the top of the infographic, and that's showing us the big M&E dominated sectors, industry and information and communications, both growing at around 5%. More domestic facing sectors, the bellwether sector perhaps, distribution, transport, hotels and restaurants growing at 1.5%. And construction growing at 2.7%, and some falls in the other big sectors, professional admin and in financial insurance, some small falls on a seasonally adjusted basis there. On the expenditure side of the accounts, personal consumption of goods and services by households up 1.8%. That's very similar to the result we had for the retail sales index of 1.6. Government expenditures up 2.7%. The value that government spends on wages and on goods and services purchased, including health in the quarter, up 2.7%. We have a strong result for investment, up 17.9%, and I'll come back to that because we have a lot of detail there showing you the increases in terms of dwellings and on M&E investment in tangible assets and plant and hardware. I guess a notable feature of the quarter is a more muted result for the M&E. So the net exports is down marginally. Imports there is up slightly bigger than the exports. So the net effect is fairly flat, given the history of the M&E data. And hence the GDP result looks quite similar to the domestic sectors in that, as I said, 1 to 2% range. So if we look at those headline GDP and GNP across time, that lower level of both of them in the quarter. I mean, we've had swings for COVID, of course, and then generally for some large restructuring of M&Es. We have big swings in our main aggregates. But this quarter, that's not the case. They're both showing a small positive increase. And again, for reference, MTD is quite a bit bigger than that in the quarter at 4.3%. So compared to a set of available European peers, we're still on the right-hand side, but down a little bit, with the Netherlands on the far right growing at 2.6%, Romania and Croatia then growing at 2.2 and 2.1 and 2%, respectively. And on the left-hand side, you see falls of 2.1% in Poland, and a fall as well in Estonia, Latvia, Lithuania, and a small fall in the UK. The EU result, the EU27 result, which is available at the moment, is showing a small increase of 0.6%. So you have the EU in the middle at 0.6, and it's typical that Ireland's towards the right-hand side, but not, I guess, on the far right with our result of 1.8%. If we go through the output side of the accounts, output or income side of the accounts, we can look at the value added in the industry and services sectors. So the two big sectors, the M&E dominated sectors, industry up 5% and information and communication up 4.9%. Then we have the next biggest sector, professional admin and support services, down marginally, down minus 0.3%, and public admin up 1.1%. An important one, distribution, transport, hotels and restaurants up 1.5%, and construction up 2.7%. So the others are there too. But what we'll see is that increased value added from M&Es is essentially largely being used for investment in the net effect has been used for investment in the Irish economy, rather than seeing the effect through trade on GDP. So looking at these over time, and as I tend to do each quarter with you, strip away various sectors to leave behind examples of the two big M&E and the two big domestic sectors. Continued growth in the two big, so 5% may look as big as historically the data perhaps would, but it's still showing that 5-year continuous growth in both these sectors, in industry and in ICT. But the domestic sectors after COVID, I guess, we can see construction back up at 100% of the Q1 2020 level. If you take that as perhaps the start of largely unaffected, that quarter was in terms of the pandemic. But distribution, transport, hotels and restaurants is still not quite back up to the Q1 2020 level, with the index here showing 91. If we look at some of the CSO high frequency data to try and explain what happened in the quarter, monthly production showed rises through the quarter, with growth in both the traditional and domestic parts of industry, smaller but domestic parts of industry, as well as the M&E data month on month. On the services side, I guess it's a little bit more mixed. The overall growth in services, but we see it a bit mixed through the quarters. That some of the sectors are up and down on the various different months. So accommodation getting a boost, I guess, early on in the quarter, and then fairly level results in May and June, while the ICT sector showed that growth on the last month in June. So when we weigh up that side of the accounts and we pull all the M&E sectors together, we get a result of 6% in the quarter. So strong enough result for the M&E dominated sectors. And the other sectors, the result for those, the domestic sectors, at 0.9%, nearly 1% in the quarter. So a little bit slower than we had at Q1 in the last number of quarters, I guess, for the domestic side of the data. And the last item on that side is to look at wages. This is the wage bill, the cost of hiring or employing people to produce that production. And we show this in current prices. And that's showing us an overall increase so in money amounts, we're seeing 2.5% increases in the wage bill in the Irish economy. And that spread is from the large increase in construction, up 6.4%, to perhaps a small fall in financial insurance, down 0.4%. So we've lots more information in the publication on a whole chapter on wages, but that's the kind of headline result from the seasonally adjusted current price wage data, with an increase of 2.5%. On the expenditure side of the accounts, so with personal consumption, government spending, investment, and then the net effect of trade, net exports, and that gives us our GDP result. We strip away if we strip away the trade effect, we get our modified domestic demand measure when we adjust the investment component as well. So building up to that, we see that increase in the blue part, consumption of households 1.8%, the increased government spending of 2.7%, and then we modify the investment data in Ireland for IP and aircraft, which are largely There's no real story, I guess, in IP and aircraft in the quarter. So the modified investment number is all about the continued investment by all firms in hardware, the extra investment that we see over the last 3 or 4 quarters in data centers, that's by M&E, that's been quite strong. And the particular story this quarter is about plants and machinery. So we've lots of examples of FDI firms spending money on new plants and increasing the numbers of production lines they have. And that's really the story behind the modified investment or the tangible investment by M&Es in the quarter. So looking a little bit more detail on those, again, on a seasonally adjusted basis, this is quarter on quarter. The 1.8% result for PCE is largely driven by services. So the goods data is a little weak at 0.5%, but the services data is what's pushing PCE. And if we look at the equivalent European measure, this consumption data, final consumption expenditure, we see Ireland's mid-table again. So that result for Ireland in the middle of the table with countries like Spain up at the far right at 3.2% and Cyprus at minus 3.5% on the left-hand side. Looking at, again, the CSO's more high-frequency monthly data, look at the retail sales index. So again, quarter on quarter, this gives us a very similar result to our consumption. The retail sales is growing at 1.6%, and we see that mixed set of items for department stores growing early in the quarter, while something like clothes growing kind of mid-quarter. So a mixed set of product growth and products across the quarter to give that overall result. For retail sales of 1.6, similar to our 1.8% result on consumption. And if we look at the time trend on the retail sales index, we can see in aggregate that was really around April. So we've, right up to July there, the most recent set of data, we've 3 months of declines, I guess, in the retail sales index. So in the monthly high frequency data, we see the growth for the quarter came out of April, and we've seen some declines in the monthly series then after that. On the investment side of the data, and that's, again, one of the interesting features this quarter, the overall strong result of nearly 18%, 17.9% on investment in the quarter, driven by construction up 4.8%. And then if we look down through this series of variables, it's machinery and equipment, and we always say, look, we want to take the aircraft out of that. And because aircraft's relatively small, we still have a high value for the growth of nearly 30%, 29.9% growth in machinery and equipment for the quarter. So that is, as I explained, the continued investment in hardware by all firms, the continued investment in data centers by M&Es, and particularly large investment, continuing, but particularly large investment in the tangible plants and machinery for M&Es in the quarter, driving the investment result. That's just to show it across time, to show that there's no IP here. So there's no IP story in the quarter, and there's no aircraft story, I guess, as well. So looking at the last component on the expenditure side, so we looked at consumption, government spending and investment. For the national accounts, the net exports are fairly flat. So down marginally. The net exports are down a little quarter on quarter. And there's lots of ups and downs, I guess, and that I'll leave to my colleague, John, to explain to you. But for the effect on GDP, there's very little effect from the international trade side of the data in terms of GDP. So when we decompose the 1.8% growth rate there on the far right into what's the international aspect and what's the domestic aspect, it's all the domestic side of the data that's pushing the 1.8% in GDP. So the question you have here is that, yes, the M&Es are driving some of the domestic aspect in terms of the tangible investment, but it's not the international trade side of the data that's driving it. It's what's going on in Ireland that's driving the 1.8% in the quarter. Then when we look at the result of that international trade, largely the profit outflows, they're pretty stable quarter on quarter at 32 billion in Q2, and that gives us our GNP result of 2.1% growth when those M&E profits are removed. If we step back a little bit and say, look, when we seasonally adjust the data, we end up with a lot, I guess, less variables. So if we step back a little bit without the data being seasonally adjusted, and we look at Q2 this year, on Q2 2021, we can show a little bit more detail and tell you a little bit more about the data. So year on year, so this quarter over the same quarter last year, GDP is up 11.1% and GNP 8.8%. But I can look down into the components and say, well, what's affecting that, the consumption data? And we can see that goods, so the overall result of year-on-year 5.6 is pushed by goods down 3.3, and that's cars. So it's less spending on cars, pulling the goods side of the data down. And the positive effect on services is coming from a strong result we have on foreign travel. So the resumption, I guess many of us are quite aware of foreign travel again, and the strong result for that, as well as the increased use of public transport. So we look at that without seasonal adjustment, we can see the detail and see that what the components are that are driving it. Similarly, on the investment side of the data, the strong result we see for capital formation. So here, year on year, it's up nearly 30%, but we can look within the building and construction data and see that strong results there is actually coming from dwellings. So it's new homes being sold, and you see that in the CSO new dwellings release. The very strong result we see for that. That's what's driving the building and construction and the investment data there. And I think I've already explained the machinery and equipment. We could see that clearly enough in the modified measures. MDD, I guess, is the summary of the deglobalized data on the expenditure side, and that's up 10.6% for reference, and a similar amount on Q1 2020. And before we finish it's been important to keep talking about this, prices. What's the effect of prices on all the data we're talking about? Everything in the national accounts is after prices are taken out, or the real effect, real GDP or volume measures. And to keep an eye on that, what's going on for the quarter. So Q2 on the same period last year, GDP is up in money terms 17.7%. In volume, it's running at 11.1%. So the implied price deflator, so the overall measure of prices in the economy there is 5.9%. On the consumption side of the data, it's perhaps easier to illustrate there. Individuals are spending 12.4% more on goods and services in Q2 compared to the same period last year. But in real terms or in volume terms, they're only getting 5.6% more in terms of the volume of goods and services. So the price effects there are running at 6.5%. So the increased prices are essentially pulling down the real effects on consumption, and that's the same for other items in the economy as well. So prices are really important to take on board when we're trying to interpret the data. So I'll finish then on the summary slide with lots of the important indicators showing a result in this kind of 1 to 2% range. GDP 1.8. Looking down the output side, we have a strong result for industry and information communication, around 5%, while some of the domestic sectors like distribution, transport, hotels and restaurants at 1.5, and construction up 2.7. And summing them up, we can see the M&E data is running at 6%, and the sectors largely unaffected by M&Es are running at 0.9%. On the expenditure side of the accounts, we see the value of goods and services consumed by individuals is up 1.8. Government expenditure is up 2.7. The interesting result we have there for investments up quite strongly, up 17.9%. The trade element, the net exports is fairly flat, down marginally, 0.9 billion, and the adjusted measure on the expenditure side, MDD, modified domestic demand, up 4.3%, again largely because of the tangible investment by some of the M&Es in Ireland. Then stripping out the M&E profits, nearly 32 billion gives us the GNP figure of 2.1%. So that's the results for the national accounts, and I'll hand over to my colleague John Sheridan to take you through the international accounts for the quarter.
Thank you, Chris. So now I'd like to take you through the international accounts for Q2 22. So we start off with our infographic, which is a good summary of the results for the quarter. We have goods exports of 85 billion and imports of 36 billion, and these combined give us a merchandise balance of 49.1 billion. We have services exports of 82 billion and imports of 79 billion, and these combined give us our services balance of 3 billion. We have income inflows of 38 billion and outflows of 74 billion, and these give us our net income outflow of 36.2 billion. And these all combined to give us a current account balance of 15.8 billion euros, or 13.3% of GDP. Our net international investment position at the end of June 22 is minus 633 billion euros, and our stock of foreign direct investment in Ireland stands at 1.3 trillion euros. Looking at our headline figure, which is the current account balance as a percent of GDP, we can still see the impact here of the large IP imports in Q1 20 and then to a lesser extent Q4 20 and Q4 21. But we're starting to see less IP imports, and you can see the much smoother series as a result of that. In Q2 22, we have our current account balance of 15.8 billion euros, or 13.3% of GDP. Looking at how this has changed since last year, our merchandise surplus is 49.1 billion euros, which is up 8.9 billion on the same quarter last year. Our services balance is 3 billion euros, which is down 2.2 billion on the same quarter last year. And our net income outflows have increased by 7.2 billion euros to 36.2 billion since last year. And these all combine to give us our current account balance of 15.8 billion euros, which is down 500 million on the same quarter last year. Looking at how this breaks down over time, again, we can see the quarters with the large negative services balances there in Q1 20 and to a lesser extent in Q4 20 and Q4 21. But again, we're seeing this overall smoother trend in our current account. Looking at this quarter compared to last quarter, our merchandise balance is up by 1.3 billion. Our services balance is down by 2.5 billion. And our net income outflows are virtually unchanged, down just 23 million. And these all combine to give us a current account balance that's down 1.2 billion on last quarter. Looking at how this breaks into exports and imports, we see our merchandise exports of 85.1 billion, which is increased by 17.5 billion on the same quarter last year, while our imports are at 36 billion, up 8.5 on the same quarter last year. On the services side, we have exports of 81.7 billion euros, which is up 10.9 billion on the same quarter last year. And this increase is largely driven by increases in computer services. On the import side, we have 78.3 billion euros, which has increased 13.1 on the same quarter last year, with this largely driven by increases in royalties and licenses and business services. On our income inflows, we have 35.9 billion, which has increased by 5.2 billion on the same quarter last year, and outflows of 70.9, which have increased by 12.3 billion. Within this, our direct investment profit and interest inflows is 9.1 billion, up 1.2 on last year, and the outflows are 38.3, up 6.6 on last year. Looking at the goods exports and imports, in Q2, our goods exports are up compared to last quarter and up compared to last year. And similarly, the imports are up compared to last quarter and last year. But while we have increases in both exports and imports, the increase in exports is stronger and is driving the increase in net merchandise exports. Looking at how this breaks down into international trade, goods for processing and other, for the international trade exports, they're up compared to last quarter, up 696 million, and up strongly compared to the same quarter last year, up 12.4 billion. While our goods for processing exports are up 14.3 billion on last quarter and 10.7 billion on last year. Our merchanting, which is a net export, is down 7.3 billion on last quarter and down 6 billion on last year. When we look at the import side, we can see our international trade imports up 7.7 billion on last quarter and up 9.8 billion on last year, while our goods for processing imports are down 2.7 billion on last quarter and down 2.8 billion on last year. If we look at the breakdown of service exports, we can see that year on year we have an overall increase of 10.9 billion euros, and within this, computer services have increased by 6.8 billion. Business services have increased by 615 million, and within this we see a small decrease in operational leasing exports of 58 million. Tourism services have increased by 915 million, and transport services have increased by 1.6 billion, showing the recovery in these sectors. While if we look at the breakdown of service imports, we can see that year on year we have an overall increase of 13.1 billion. Within this, royalties increased by 4.2 billion and business services increased by 5.6 billion. And within the business services, R&D increased by 3.3 and miscellaneous business services increased by 2.3 billion. Tourism services increased by 1.3 billion euros, again showing the recovery in this sector. Looking at the royalty imports in a little more detail, the blue line here gives us the total royalty imports, while the green bar gives us the amount of royalty imports related to the pharma sector. And most of the difference is related to the ICT sector. For pharma, we can see an increase compared to last quarter and compared to last year. And similarly for the overall level, we can see an increase compared to last quarter and compared to last year. But we are seeing a small decrease in the ICT imports of royalties and licenses. Looking at our direct investment income, we have inflows this quarter of 9.7 billion euros, which is up 1.5 billion on the same quarter last year. And we have outflows of 41 billion euros, up 6.9 billion on the same quarter last year. And these combine to give us an increase in net direct investment income outflows of 5.4 billion euros compared to last year. Looking at the figures compared to last quarter, our inflows are up by 1 billion euros, while our outflows are down by 1.3 billion. And these combine to give us a net decrease of 2.4 billion euros compared to last quarter, giving us our net outflows of 31.3 billion. Looking at how this direct investment income outflow breaks out, we can see that our income on debt is fairly flat. We can see the usual lower dividends in Q2 compared to the previous quarter, similar to the pattern seen in Q1 21 and Q1 20. But with only a small decrease in direct investment outflows overall, this results in larger reinvested earnings this quarter. Looking at how the profit outflows break down by sector, we can see compared to last quarter a decrease in the manufacturing sector, which is down 4.6 billion euros, and an increase in the information and communication sector of 1.8. But if we compare to the same quarter last year, we can see an increase in the manufacturing sector, which is up 5.5 billion, and an increase in the information and communication sector, which is up 1 billion. If we look at our trade income and our current account with the UK, the trade balance with the UK is decreased by 411 million, and net income outflows have increased by 1 billion compared with the same quarter last year. And these combine to give us a current account deficit of 1 billion euros with the UK, down 500 million from the deficit of 500 million in the second quarter of 2021. Looking at our financial accounts, again, we can see relatively low level of net transactions compared to previous quarters. Our direct investment has increased net by 24.5 billion. Our portfolio investment net has decreased by 32.6 billion. And our other investment net has increased by 14.7 billion. Looking at our international investment position for Q2 22, the position is minus 633 billion at the end of June, which is an increase of 23 billion on the end of March position. And this change is predominantly driven by changes in non-financial corporations. So to summarise, we have a current account balance in Q2 of 15.8 billion euros or 13.3% of GDP. And we're continuing to see the low levels of IP imports we've seen in the last few quarters. We're starting to see the COVID effects lessening, with tourism and transport, exports and imports coming back to more usual levels. And now I'd like to hand you back to Jennifer to summarise.
Okay. Many thanks, John, and many thanks, Chris, for taking us through the results. I'll just recap on some of the headline figures from this morning and why people are organising or developing questions. So for quarter 2 2022, we have a GDP growth of 1.8%. GDP is a whole of economy indicator and gives us that sense of the broad level of economic activity in Ireland in quarter 2. GMP then increased by 2.1% in the quarter, and GMP, the difference between GMP and GDP is that we remove multinational profits. It's the main reason the difference between those two. And we see a growth there of 2.1% in GMP. Modified domestic demand, one of our modified indicators, an important indicator of underlying domestic activity, and it measures personal and government spending and investment spending, but doesn't include the impact of intangibles. That's increased by 4.3% in quarter 2, and Chris has explained how that's driven largely by growth in tangible investment by MMEs in machinery and equipment in Ireland, that investment in Ireland. And then as we go down through the accounts and we zone in a little bit further, we have personal spending or personal consumption and expenditure, which is what we spent on goods and services. And we see that increase by 1.8% in quarter 2 2022, bringing us back to a level very close to the levels of personal consumption expenditure in quarter 2 2019, which was just above 28 billion, and we're just below 28 billion now with this growth in quarter 2 2022.